Thanks for joining us on today's edition of Business Daily. Coming to you live from Seoul, I'm Lee Ji-yoon. Before we get started, let's first take a look at today's highlights. After a violent tumble in its stock markets, concerns are mounting about the world's second largest economy and whether it's showing signs of flagging. We take an in-depth look at this. Korea is looking to reshape its stock exchange in hopes of giving it a boost in investment and more growth in profits. But not everyone is agreeing to this plan. These stories and more coming right up. Following the Greek vote to reject additional austerity measures from its European creditors, world markets reacted with a wave of downward arrows. But the fall wasn't as deep as some analysts had feared. Investors took a wait-and-see approach with all main indices at the New York Stock Exchange dipping by less than 0.4%. London's FTSE slipped by 0.76%. The euro fell by 0.5% against the US dollar and 0.6% to the pound. Meanwhile, Korea's benchmark KOSPI took a beating on Monday, recording the biggest daily fall in 3 years, with a plunge of 2.4% by the end of the trading day. Korea had a total of 8 items that topped the global market share of products or services last year, up from 6 a year earlier. This is according to the Japanese business newspaper Nihon Keizai Shimbun, which conducted a survey on the superiority of 50 products and services. Korea's standing grew thanks to categories like shipbuilding, smartphones, liquid crystal panels, and lithium-ion batteries. Korea beat China, which only had 6 items leading global market share. The U.S. topped the list with 16, followed by Europe at 10 and Japan at 9. 24 companies here in Korea are vying for 2 new duty-free licenses that will be decided by the Korea Customs Service on Friday. The license would allow its recipients to run a new duty-free shop in downtown Seoul and jump into a market that's valued at nearly $7.4 billion. The duty-free shopping sector has grown by 22% since the year 2013, attributed to shoppers flocking in from China and Japan. Another big change could be on the horizon for Korea's stock markets, which the government plans to revamp by separating the bourses into subsidiaries, overlooked by a single holding company. Our Eunice Kim explains why.
Korea's web portal giant NHN in 2008 ditched the tech-heavy KOSDAQ to move into the main bourse, the KOSPI. Nexon, the free-to-play mobile gaming heavyweight, left the Korean stock market entirely and listed with a bourse in Japan in 2011. Just a couple examples of how Korea's stock markets have taken a hit, and the government is now moving to reform it. To boost their competitiveness and encourage new listings, the Financial Services Commission has decided to split the KOSPI and the KOSDAQ into subsidiaries, with the Korea Exchange as their holding company.
By establishing separate entities, we'll be able to foster KOSDAQ's identity as a main board for innovative startups and high-tech enterprises.
The move would follow the lead of competitor exchanges, with the Korea Exchange to focus on growing profits and expanding into new business sectors. But those who oppose say the revision is much too ambiguous and would only stir up confusion. They also argue relaxing rules could lead to unqualified companies going public, leading to a repeat of the stock asset bubble of the 2000s.
Making a holding company is not the only way to grow competitiveness. As this can lead to a collapse of our capital market, we're not ruling out an overall strike.
An upward battle is also expected at the National Assembly, where the reform plan must pass legislative review. The proposal is set to be submitted later this year. Eunice Kim, Business Daily.
Now, Greece has been topping the headlines with its ongoing debt crisis, but also in the spotlight is China. The ups and downs that we've been seeing in its stock market have caused much alarm, leading to the question of whether its growth remains sustainable. Let's find out what this is all about.
It's been a roller coaster ride for Chinese stocks over the past year. Its key Shanghai Composite Index hit a 7+ year high last month, up more than 150% from its low last year. But a rapid slide alarmed investors, with the bourse shedding nearly a quarter of its value after topping out 3 weeks ago. China's economic growth rate also slowed to about 7% in the first quarter of this year, recording the lowest in 6 years. And experts forecast the rate will be crimped even further in the second quarter. Beijing and financial authorities have taken steps to intervene and have been propping up the market by cutting interest rates and relaxing lending rules. Will China be able to shed market woes, and how will it tackle the issue of less sustainable growth down the line?
And to tell us more about this, we're now joined by Professor Chuyoung from Yonsei University. Welcome to the program.
Hello, good morning, Jiyoon.
All right, so let's start with China's Shanghai Composite Index. How do we understand the sudden plunge that we've been seeing recently?
Well, for years, the Chinese economy experienced lower growth. And in contrast, the stock market index in China went up, which is extraordinary. So my interpretation is that investors in China expect or believe in recovery. At least the rising stock market index previously suggests that people think the government will do something for them. So therefore, the recent fall in stock market index means reflection or the acknowledgement on the investor side that the Chinese economy is no longer growing. On the other hand, the stock market previously that did not move along its economy certainly had a bubble factor. If the bubble burst, then it may cause a serious dissatisfaction with the Chinese government or the Chinese Communist Party.
All right, then should we be concerned about this? I mean, will the effects of this spill over to Korea?
Well, unlikely the global financial crisis that occurred in 2008, the impact of the sharp drop in the Chinese stock market on the Korean economy or the Korean stock market would be very limited or partial, if any. Why? Most of all, even though the foreign investors are pulling out the money, the Chinese investors are still crowding into the stock market. In addition, the Chinese government this time made a very quick action to respond to the changes in the stock market, and in an attempt to recovery, the government has introduced a few financial measures.
All right, like you said, China's central bank recently cut interest rates and also reserve requirement ratio in a bid to stem the slowdown. What are some other stimulus efforts that Beijing has been putting out?
Drops in interest rate and the reserve ratio, well, both intend the same thing because they encourage the bank customers into spending or investing in something else other than bringing the money to the bank. But they are very direct and the active controls. Traditionally, Chinese government has preferred more indirect controls, such as the liquidity support or the easing regulations on the real estate. And these measures, indirect measures, I mean, they are still at work. So the fact that Chinese government this time is tackling with direct control means that the government now regards the situation as more critical and more urgent for intervention.
All right. Well, experts are also saying that it might be difficult for China to meet its growth rate target of 7%. Would this be signaling the slowdown for the Chinese economy, in your opinion?
Yes. It's the lowest number, and the economic slowdown in China already began. China is based on the manufacturing industry, selling the products to global customers, and the global economy is now not strong enough to enhance the Chinese economy at the same time. Although the size is increasing, the domestic middle-income consumers, the basis is not large enough to increase the growth rate.
All right, then how would a slowing Chinese economy really affect Korean exporters, considering that China is Korea's biggest trading partner?
Well, it's going to be very bad, and the slowdown in Chinese economy will smash the Korean exporting sectors, and I think particularly in the high-end goods. Well, if the time is bad, it triggers the consumers into a more reasonable and affordable shopping. So overall, my idea is that the Korean exporting sectors will be negatively affected, and there will be a sectoral variation.
All right, so I guess we'll have to keep an eye on what the Chinese government will do from here on out to keep the momentum going.
Sure.
All right, thank you so much for coming in today, Professor.
Thank you.
And that wraps it up for today's edition of Business Daily. Thank you so much for staying with us throughout our program. And we'll be back tomorrow at the same time, same place. Until then, bye-bye.